So, hey, everybody, welcome. What is today even, David? I don't even know what today is.
It's the
Thursday.
22nd of January. I know that because my middle son is 17 today. So 22nd.
Oh, man, happy
January.
birthday. Happy birthday.
We're excited for him.
So here we are doing our piece with David Childers from Keeping Current Matters, and really it's one of my favorite things that we do at LabCoatAgents, and I'm honored to be on this with him because, well, I get to be seen, and he gets to do all the talking, and if anything's wrong, we just point at him and say he was wrong, not me. But he always brings awesome insight, and today I'm sure we're going to talk about some great things. I know I got a couple of questions. We might not even know the answers to them yet, and we're going to just jump into it. So, David, how are you doing today?
Doing wonderful. Thanks for that intro. And it's always fun to come back together a couple of weeks, since things have happened. We've got some new news out there. That's what I'm always trying to say. Okay, what's happening that's, newsworthy in our business, and try to bring that to you, try to give you something to give you perspective and give you something to, certainly talk to clients with about the market today.
Yeah, awesome. And that's what I love is the current trending stuff. And for agents, man, I get it. You're going 100 million miles an hour. And if you got Clubhouse, now all of a sudden you're on Clubhouse. So what's happening maybe in the news, you might not even be seeing because you're being infotained or you're working your face off trying to get that gold number that you're trying to go for, hit those goals and stuff. And David is a breath of fresh air, brings in lots of analytical data to back up everything he's saying. And so we're going to just jump right into it. What do you want to talk about first?
I have a couple things I would start off with today. One, I see a lot of people in the chat, and we have people on Facebook. And Johnny, if you can watch that as I'm talking, I'd say ask a question if you have it. So put that there in the chat as we talk. Johnny, tell me what your questions are. I don't know if I'm prepared to answer them all today, but let's get them out on the table because I know they're important, and they're probably ones that other people are thinking too.
Last time we talked, there was turmoil. We didn't know what was going to happen 2 days ago.
Sure.
What's happened, and it is what it is. We move forward from that, and that's not the discussion. But there is talk about the new president having some form of tax credit for first-time buyers.
Sure.
I don't know anything about it. I don't know if you do, and I don't know how it's going to work or when they're anticipating the rollout of that.
Yeah, I don't know. I mean, there's been several things that have been said recently, right? There's credit. There's the opportunity for the dreamers, to now qualify for FHA loans. There's several things happening. My sense right now, Johnny, is there's more to come out on the specifics of that, on what is going to be a part of those programs. So as we see those, we'll try to, we don't do as much, truthfully, at KCM about political type things, but where it starts to intersect with our business, we stay on top of those things. But I think the one thing that as you look at that is we look at what's going. I'm going to bring what experts are saying because it's starting to change a little bit about the coming market, and I think we can expect the change to happen, relative to how folks are forecasting the 2021 market. Because, one day you may hear, hey, things are going with economic recovery or, vaccine rollout, whatever it is you're following. The next day we may hear, okay, we got a little bit of a slowdown in that, particular area. So I think we're still going to look, week in, month out, and that's why these are so important to do. I'll try to bring those things that are changing. I've got some of those today. But we live in a world right now where there's, I think what we all want is a little bit more certainty, a little bit more just let's get into where we don't turn on the news the next morning and, what's happened. And I think we're heading that way, but certainly have come out of a time where uncertainty has been on a lot of people's minds.
Yeah, it surely has. And security, certainty, that is something super important. And, we see it out there right now with lack of inventory. We see it with.
I'm going to talk about that today. I'm going to talk about that across the country.
Good.
About that. It's a big issue, obviously, but bring some perspective to it.
And what are rates doing? Are they starting to creep up? Are they staying the same? What are we doing?
Yeah, I think, it's interesting. We saw the average 30-year fix last Thursday go up to, I believe it was 2.79% as measured by it's Fannie Mae that brought us that, and then Freddie Mac, I'm sorry, and then saw a slight dip this week, about 2 basis points on that to, still in the same area, 2.77. And so I think we're going to see some choppy waters relative to home loan rates. Looking into this year, forecasters are still saying we're going to be in a wonderful rate environment. If you remember the slide that we talked about last time we were together, when home prices rise and interest rates rise, it just means the home cost more. So we will likely remain in a very strong, I'm going to say, interest rate environment, but it's going to cost more as we go throughout the year. And let's kind of start there, because I've got some interesting information. I'll share my screen here. I always have a few visuals that I want to share, Johnny, that we'll talk about them. But I brought, again, just updated home price forecasts for 2021. You can see there. And if you followed us and have seen this before, it may look the same. It may not. They've actually risen. Last time we were talking, the average was below 4%. Now we're seeing many more experts saying, hey, we're going to see, higher appreciation this year as their current forecast are giving them. Now, price is always going to be determined by supply and demand. We talk about that. You've heard us talk about that. And these are taking into account what's going on with demand, what's going on with supply. And I'm going to talk about that because it's probably one of the biggest issues right now is the lack of supply across the country. But no doubt, home price forecasters are forecasting, I would say, a very good year for home price appreciation going into 2021. Likely, more homes on the market in the second half, but we'll get to that in just a minute. If we look at one of the leading indicators of our business, I would say purchase applications. These are mortgage applications. People have asked about that before. What do you call a purchase application? This is somebody sitting down, filling out an application to obtain financing to go out and buy a home. You can see
new financing, right? Not refi.
Correct. This is just purchase. So that's the key differentiator. The way the business obviously would do is determine that by purchase refi. This is only purchase. So we can see year over year. So this week as compared to the same week last year, we've been up since the lockdown of April and May of last year, and have been up considerably throughout the year. These are all the people that are like, hey, we're going to make a move now. We want to do something, and we know what that brought in the 2020 market. And we can see we're still up. Even those yellow bars are holiday weeks or orange, whatever color that is. We see a dip down and people, maybe doing something for the holiday, and we're still up, not quite as much as we were in the fall, but still up year over year in applications. Now, the Home Price Expectation Survey just came out this morning and confirmed that, we've been saying this, but in 2020, we sold more houses than 2019. And, it's because a lot of people going out there saying we need something new, and we're seeing that continue on into 2021. More and more people, applying for financing. You asked about mortgage rates, Johnny. Here's a great quote from Sam Cantor from Freddie Mac. Mortgage rates have hovered near historic lows for almost a year, fueling purchase and refinance activity amid a global health crisis. We're now seeing rates fluctuate a bit as political and economic factors drive Treasury yields higher. However, we forecasted rates to remain relatively low this year as the Federal Reserve keeps interest rates anchored near zero for a longer period of time, if needed, until the economy rebounds. So, I think we're looking at this to start to see interest rates slowly creep up. I'm not here today to forecast when that's going to happen or what's going to happen tomorrow, but as the economy improves, we can expect interest rates to continue to slowly rise. So what does all this mean? We're talking about good market, people going out there applying for financing, interest rates starting to creep up, and maybe you're feeling that, maybe you're not. I think the word is going to get out there. We're going to see a lot of people say, okay, I need to act now before they rise. But here's the moral of the story. Housing affordability right now is in a great spot. NAR releases their affordability index, and we can see right now that blue line there, it's at 168.2. So the way you read this index, and this goes all the way back to 1990, this graphic here, is the higher the index, the more affordable a home is. And you see there in the yellowish orange color there, the years when distressed properties dominated the market after the housing crisis, when we saw all the inventory come to market and all the issues that we remember from that, houses became very, very affordable. Well, where we stand today is very similar to, I'm going to call it 2014 and 15, kind of the tail end of some of that affordability that we saw. And, homes got less affordable in 2018 and have gotten more affordable over the last couple of years. Why is that? That is a factor of rising wages and lower interest rates. So even as homes appreciate in price, they've gotten more affordable due to low interest rates. Now, here's the interesting piece, Johnny, and I'll turn it back over to you here in just a second. Here's the thing that's interesting. Owning a median price 3-bedroom home is more affordable than renting a 3-bedroom property in 572 or 63% of the 915 U.S. counties analyzed for the report. It's according to Adam data. That has happened even though median home prices have increased more than average rents over the past year in 83% of those counties and have risen more than wages in almost 2/3 of the nation. That's a big story out there right now, Johnny, that, I'll stop sharing here for just a second, is that, prices are rising, no doubt. We saw appreciation last year, and we still have more to come out on the official, how much did homes appreciate in 2020. But these low interest rates, the economic conditions are making homes more affordable, even more affordable in the majority of counties than renting a place. So something good that I think we can look at right now and say, that's a message we need to get out there to folks, thinking about that are renting, thinking about buying.
Sure. I mean, it's at that price, I hate to say it's free money. It's not really free money, but it's almost, you can see the direct correlation between 2018 and the last year that you had up there, 2021, on the affordability. And that's directly related to the rate, right? Because now all of a sudden your cost per $100,000 is much less, or cost per thousand, whatever you do. It allows you to buy more. Yeah, the prices are going up at the same time, but it's that money that to get that subpar 3% is ridiculous. Somebody asked a question, Nikki Dutra asked a question, what are you seeing on investment rates? Do we see anything different happening in there? Do you have
I don't understand that question. What is that?
So
an interest rate for an investment property?
Correct. Yeah.
Typically, say again?
Are we seeing anything different there? Didn't know if you had any data off the top.
As far as the average interest rate?
Yeah, for investment properties.
I can't, specifically speak to that, other than what we know is that there's typically going to be risk-based pricing, applied to an investment property. You're going to get your best financing on owner-occupied, you know what I mean? So anytime you deviate from that, whether it be a second home or investment, you're going to pay a little bit more on that. But I think we're going to see whether it's a second home, whether it's investment, still a very, very good interest rate environment for that. But it's going to depend on the bank and how they price that out.
Yeah. Now you touched on something, and I'm surprised at how many people in our industry don't understand how the mortgage rates are arrived at or work. And they think, oh, wow, they slashed the interest rates today, down to such and such. But that doesn't necessarily have anything to do with the mortgage, right? They follow more the treasury bonds. Can you explain that a little bit?
Correct. Yeah. For the last, however many years, 30 plus years, the 30-year fixed rate has followed the 10-year treasury. So that's the one you really want to look at. The reason we're seeing such low interest rate environment right now is because of all of the secondary bond market purchases that the federal government's doing. They're really kind of pinning rates low right now, which is not operating exactly how the market would normally operate. So when you hear them talk about the yield curve, the spread there, typically runs in unison. But when you have the federal government buying the mortgage-backed securities like they have, it's pinned rates low. We've been the beneficiary of it in housing. And so what you can expect is the economy improves. That what's the government want to do? They want to bring money into housing because they know what housing does to the overall economy. The U.S. economy will not improve until housing leads the way out of it. And, I've gone over this many times, the impact that a home sale has on a local economy or a national economy, and it's significant. A new home sale has $88,000 worth of economic impact in an existing home, about half of that, about $44,000 of impact. And so you're seeing the federal government come in and say, okay, we want to stabilize housing. We want to drive these interest rates low so more sell and the economy improves. And that trickles down to the commissions, we receive, to the manufacturer of blinds, you know what I mean? Everybody that's a part of that transaction. So I think we can expect more of that into the year and being a very good interest rate environment.
Yeah. I agree with that. I'm going to ask this one question and then we can move into the new construction after that. But what are we seeing right now for the most popular loan type on purchase? Is it still conventional, 20% down, FHA? Do we have any data on that?
I don't have that on a specific product. I would guess it would be a 30-year fixed. I would think that would be coming out of the housing crash, we saw a lot of people say, hey, I don't want to participate in different products. I'm of the opinion there are no bad financial products, or just misused financial products. Mm-hmm. And so I think we see people being in a 30-year fix more than any other product right now. And then that'll probably grow as time continues on. The second thing, I did see a report this week on the average down payment of a first-time home buyer is 6%. The average, somebody else that's not a first-time home buyer is 12%. So why is that important? And Sue made a comment in here. It says a lot more programs for first-time home buyers. That's right. There are a lot of programs, whether it be great website, down payment resource. I don't know if you guys have seen that. You can go check that out, and they can show you in your area what are the resources for first-time home buyers, whether it be grants, different things like that. But the challenge that we have in the market relative to first-time home buyers and renters is twofold right now. One, data clearly suggests that I think it's about 40% of renters or people that are thinking about buying think it takes 20% down to buy a home. First thing we got to do is get out there and say it doesn't take 20%. There are many programs that take far less than that, and even if you're a veteran, you can qualify for a no down payment a VA loan. And so I think being aware of that, not being the expert in that, but being aware of what those opportunities are. The second issue right now in the market is this economic slowdown has disproportionately affected those on the lower income scale. And think about renters, think about people that are thinking about buying, that want to buy, that may have had their savings or may have had, to reach into some of that to get through this. So I think being aware that those that are thinking about buying may be going, gosh, I don't know how I'm going to buy now. And that could be a combination of a program in your local market. Could be a combination of helping them see you don't have to have 20% down. Could be something else if they're a veteran accessing VA benefits, things like that. And I think our job is to get out there and tell that story.
And that is the downside to appreciation. So as the price goes up, you've got to have that DDI, debt to income ratio, to qualify for that higher. Even though prices are coming down, it kind of balances out, but you got to have that. So yeah, I can definitely see how the lower income people would be impacted by that. Good stuff. I got two great tips I'm going to share at the end from all of this. Let's jump in. Let's talk about new construction. What are you seeing?
Yeah, let's look at, I've got, let's talk about inventory here real quick. I'll show you where we're at new home inventory, but let me share this real quick. Here's just a quick snapshot. We use this a lot of times of the year-over-year change in key metrics. There's not a lot here that I would say, okay, it's going to be surprising to you. You can see showings, applications, pending deals, all that. We're up year over year. It's been a very good market that's continued on. New home inventory, you just asked about, Johnny, down about 11%, but we know builder confidence is high. We know starts are high. We know permits are high. So they're bringing inventory to market. The real challenge right now is existing home inventory across the country is down 43%. And I'm certainly not telling probably anybody on this call something they don't know, but I just want to kind of show you that we're in a severe deficit relative to inventory across the country. If you want to look at that in a different look, this is a look at the year-over-year change in listings. The green line shows listings being brought to market. The orange line there shows, the amount of supply, like what's on hand. And so this tells the story. We saw new listings drop. That's over the holiday weekend, and they're, coming back or holiday week. And, people are buying homes across the country faster right now than they're even coming to market. And that's why you see the dip on total listings. If we look at that on the map right here, this just tells the story of by state where we stand relative to the inventory. You can see, depending on the state you live in, Utah down 60% year over year in the available inventory, and look across the country there, many states 30-40%, if not lower, in the inventory they have of homes for sale. So
what's your take on
issue?
What's your take on New York right there, -1 by 1? Does that mean there might be a lot of listings and people leaving? Is that do I read that correctly?
Well, New York's always going to operate a little bit differently in New York City, in the state of New York. Now, I did a presentation last week for the Long Island Board of Realtors, a great group of folks, and we talked about that. There are markets in New York that are oversupplied right now. New York City being one of those places that people said early on, we want to get out of here. So there are some areas there that have more, listing inventory than they had this time last year, and so that's why they're operating very differently right now than the rest of the country. You look at Hawaii as well. There's not a lot of people flying to Hawaii right now looking at real estate or thinking about doing that. So there definitely are markets out there that are operating differently than the rest of the U.S.
Steve asked if this graphic is available on KCM.
It is, yeah. If I'll turn these slides over to the LabCoat agents, they can make them available. You can email me too at david@keepingcurrentmatters. I can send you this slide if you want it. But yeah, it is available there in our monthly market report, I believe. The next one more slide before we talk about this, Johnny. 3 reasons that homeowners didn't put their house on the market in 2020. Financial uncertainty, life uncertainty, COVID health concerns, all those things we talked about around uncertainty, playing into why people are not putting homes on the market. Why is that important? A couple of things I want to say here. You saw what experts are forecasting for price appreciation. They're forecasting prices to appreciate in a very healthy way. Around 3% is about average price appreciation in this country, and we're talking in the 5s is what experts are saying right now. What's interesting about that? One is experts are expecting more homes to come on the market. We used the analogy before about homes being almost this year like toilet paper, and I'm sure you've seen the meme that's been here and other places that it gets bought as soon as it hits the shelf. It's the storekeeper that can't stock the shelves. As soon as the inventory comes in, people come in and snap it up. Now, I would make this analogy, Johnny. If you and I worked at that store, at that grocery store, maybe there's going to be several trucks that are going to back up to the store that are going to bring inventory this year. It's going to be the builder truck, I'm going to call it. A lot of new construction coming to market because builders are saying, okay, people are ready to buy, they're ready to design a home. Unfortunately, the forbearance truck's going to back up. There will be people that will be affected, and whether it be they're forced to sell because of that or they go into foreclosure, whatever it is, that will bring more inventory to market. And then just simply, people will, as things get better, will feel more comfortable in selling their home. There's a lot of people that said, you know what, we don't want a boatload of people coming through our house right now. Exposing us to whatever they may expose us to through all of this. And so I think you can expect more and more homes to come on the market this year, likely in the second half than the first half. People still ask, are we going to see this wave or spike in foreclosures? We're going to see more foreclosures as a result of forbearance, but not a crisis level of foreclosures. Right now foreclosures are at historical lows. I just looked at the most recent numbers, and you can expect to see. Don't be shocked if you hear foreclosures just doubled in the country. Foreclosures tripled in the country. Foreclosures are 4 times what they were, and that will be the headline. But when you compare that to the 20,000 foreclosures there were in the third quarter of this year, it makes sense. So I think we can expect more and more people to list their homes, more and more activity in the market as we go along.
All right. Jake told me we got to wind down. They need the link, but I want to end it with some tips because hopefully y'all picked up on this. One, we looked at a slide, and what I picked up from that slide is from 2011 to 2015, people who purchased to now have equity in their home. Reach out to them. Some of these people may have bought to hold or whatever like that. 20% down myth. Educate yourself. Do a virtual seminar or whatever, webinar about the myths of, and you can have this running on replay and evergreen. The myths of 20% down, or how to buy a home with 0 or 5% down, or whatever it might be. And you said the average was 6% down, right? I used to how to buy a home with no money down. USDA actually RD has that program. We talked about this 2 times ago, and those are the people exiting forbearance. Right there is some people that don't have an exit strategy, and you can get all of it. You can get a lot of information through Cole Realty Resources, or Sales Genie is another one that I use. How long have they owned the home? You go in there, you put these parameters in there, and you can do that. And you can start to, it's all about the data. It's all about figuring out. It's all about getting to the client and knowing the need. And that's why the big Z one, and some people don't like to talk to, they met the consumer where the consumer was at. So that's all we got. We're getting kicked off today. I would go all day long with you, David, because I love the information and the analytics. But Jake is going to make us all disappear in a minute. So I want to make sure that, hey, I'm doing it.
That was pretty neat.
I had this piece of green screen that sits on my desk. Sometimes I'm just ahead, right?
I hear you. I like it. Yeah.
So anyways, I appreciate that. I hope the audience appreciates that. David, how do they find you? How do they find the company?
Is always, listen, and all those things you're talking about, Johnny, whether you're making a video, you're doing something, go to keepingcurrentmatters.com, go to the blog. You can grab all this information and use it to show visuals like that, to say, hey, look, a lot of people think you have to have 20% down. You don't. And let me show you how, so love it. Thank you, Johnny. Always love being on.
All right, man. Be safe, everybody. Take care. Thank you, David.